As a continuation to the previous video where we discussed this post that said, hello members, I am due for retirement next year, October. I have never done business. I saved 5 million in a certain circle, which gives me 500,000 yearly, sorry. My lump sum pension is around 3 million. I am in need of financial advice. Thank you. We had reviewed some of the comments that came through for this post, or some of the advices that were given for this post. And I had mentioned or indicated that the next time we do a video on this, we will now be doing the actual portfolio allocation, or we'll be doing a simulation for a portfolio allocation to suit this person's needs. At the face of it, having worked your entire life or having worked your entire active years and you don't have any other savings save for the circle, you're striking me like two possibilities, yeah? Number one, either you lacked information. You did not know that you can actually invest in treasury bonds. You did not know that you could actually invest in shares and have the potential of making more money. You may have not been aware of MMFs, or you may have not been aware of special funds, or maybe you are aware of MMFs, you're aware of special funds, but because it's easier to access the monies, especially after the lock-in period, it's easier to access the monies as opposed to circles, you opted for the circle, all right? The other option is that you are a risk-averse investor. You fear losing your money. You can't just imagine losing 1 shilling out of your money. Or maybe you are an investor who is risk-averse. You don't want to take chances with your money. Your risk tolerance is quite low. You're the kind of investor that if you're to buy shares today and you wake up the next day and find there's a 5% reduction in share prices, then you'll instantly sell your shares at a loss, okay? Because you just don't want to take any risk. Your risk tolerance level is quite low. Now, to suit this investor's objective or risk appetite level, their objective, someone who is going into retirement, what objective could this person be having? Number one, you need something that can give you cash flows. So you need an investment that is income generating. So this is going to be locking out land, especially property, vacant land, because it is not income generating, not unless you put it into gainful use, all right? You also need an investment that can preserve your capital, because you don't have the luxury of other years or other active years to generate more revenue. So we are going to work towards a conservative portfolio. And what's a conservative portfolio? A conservative portfolio is a portfolio, like its name suggests, focuses on preserving your capital. Capital preservation essentially means that making not losing your initial principal. Like if you invest the 5 million, you don't lose the 5 million. You earn 500,000 in year one, and you reinvest that 500,000 so that your capital is now at 5.5. Your portfolio should preserve the 5.5 for you. So a conservative portfolio is a portfolio that has a heavy allocation of the low risk assets. It's a portfolio that is heavy on treasury bonds, it's heavy on treasury bills, money market funds, the circle like our friend here, fixed deposit in banks, and so on and so forth. Very low risk investment, okay? A portion of that portfolio could also go into moderate risk, and into the high risk investments, but very minimal, like say maybe 10% or even 5% of that portfolio, of course, depending on your risk appetite and how far you can stretch that risk appetite. So what are the characteristics of a conservative portfolio? We're going to be going through that in the next part of the video, but before that, allow me to remind you to please press the subscribe button to those who have not subscribed as yet, and click the notification bell as well, so that whenever I upload a video, YouTube can always notify you. All right? Thank you, and thank you for tuning into your home of financial freedom. Now, the key characteristic of a conservative portfolio is in the portfolio allocation, asset allocation. Like I've said, this is a portfolio that is heavy on low risk investment. You could be having an 80% of low risk investments, and the 20% of your portfolio is now allocated to moderate risk or high risk, or you have a 70% in the low risk investments, and then the 30% is allocated to your moderate risk and your high risk investment. So the asset allocation, the way you allocate assets in this kind of a portfolio, is what we'll be describing the conservative portfolio. It is heavy, top heavy on low risk assets. And remember, the low risk assets are the assets that essentially are motivated to preserve our capital. These are investments that, yes, you can lose your money, but chances of losing your money is very, very minimal. Is capital preservation. So that means essentially, that the conservative portfolio is defined by the asset allocation. It offers us capital preservation. It offers us steady income, or it gives us steady cash flow, passive income. All right. Now, it also has the potential of giving us a moderate growth. Now, this is where the 20% allocation on the moderate to high risk assets comes in, because the low risk assets might potentially predispose you to inflation risk or horizon risk. We are going to discuss that towards the end of the video. But you need to have, in the conservative portfolio, you need to have a portion of that portfolio allocated to the moderate or high risk assets, which then has the potential of paying you more or offering you capital growth or wealth growth, okay? Which you also need in your retirement, because inflation is going to eat you up if you don't do that. So what are the strategies? How then would you ideally come up with a conservative portfolio? Remember, at the end of this video, I'm going to give you numbers, okay? So how then would you come up with a conservative portfolio? What strategies would you employ in order to simulate, or in order to have an effective conservative portfolio that meets this investor's risk appetite? The minimal risk appetite. Number one, diversification. Diversification is the number one option or number one strategy for minimizing your risk. All right. In fact, Warren Buffett calls it's an insurance against ignorance. And like we have said, there's a possibility that this investor might have lacked knowledge on investment. And like Warren Buffett said, let us take that insurance against our lack of knowledge. So we are going to have to diversify this portfolio or diversify this investment, okay? Another strategy is portfolio rebalancing. What's portfolio rebalancing? Just like we do with our cars, you always have to take it for wheel balancing and realignment. So with the same breath, you need to periodically assess your portfolio, assess your risk appetite if it has shrunk or it has increased, and then realign your portfolio or rebalance your portfolio to match your revised objectives or your revised risk appetite. For instance, this is not somebody that you take to shares right away and tell them, put 1 million in shares, even though you know that there's a potential of the person earning maybe 2 million or 3 million in the next 2 or 3 years. All right. You are going to start with a small investment in the high risk asset, in the equities. Could be even 5%. But as time goes by, as the person gains more knowledge on investment, as they understand the market dynamics, as they understand the market operations, as they understand the elements or the relationship between risk and returns, then you can always rebalance this portfolio to increase the allocation to certain assets, maybe equities or other assets, okay? Another strategy on this portfolio is you focus on income. Like I have said, this is not the kind of a person, or this is not a portfolio that you'll be using to acquire vacant land, especially if you don't have the mindset or if you don't have the intention of using that land or putting that land to active use. Okay, I am not saying that land is not an asset. It is an asset, but it is not an asset that fits in this specific person's objectives or requirements at this particular moment. Now, another thing that you need to focus on is liquidity consideration. How easy is it for you to convert your asset into cash? That is what is defined by liquidity. Liquidity is the ability for you to convert your asset into cash. So money is liquid. Cash deposit in your bank is liquid. Money in your money market fund account is liquid. Money in your special funds during the lock-in period is not liquid because you need to wait for the 6 months. Thereafter, you get your money on demand. Therefore, is it liquid or illiquid? You tell me in the comment section. Now, so far, we have managed to do a risk profiling for this client, and we have managed to ascertain that he's a conservative investor. We have discussed what a conservative portfolio is. We have discussed how the strategies for coming up with a conservative portfolio and the characteristics for a conservative portfolio. Now, what we shall be discussing in the next part of the video are the advantages of a conservative portfolio and the limitations or the disadvantages of having a conservative portfolio. But before we do that, let's simulate a portfolio for this guy. Remember, he had said, hello members, I am due for retirement next year, October. I have never done business. I saved 5 million in a certain circle, which gives me 500K annually. My lump sum pension is around 3 million. I'm in need of financial advice. We have said we are going to do a conservative portfolio. So we are going to apply or allocate 70% of this amount into low risk assets rather, 20% of this amount into moderate risk, and 10% of this amount into high risk. All right. With that in mind, so we are going to allocate 500,000 shillings into a money market fund account, 1.1 into a fixed income fund account, and we are going to apply 3 million into bonds. 800,000 will remain in the circle, and then we'll allocate 500K into 2 special funds. The third special fund will be having 600,000, and we'll take 3 equity funds of 200,000. Now, at the end of the day, we are going to expect to receive a sum of 1.2 million in a year. Can it be better than this? Yes, it can be better than this. But remember, we have a conservative investor who is not willing to take on to high risk. So we are not going to expose him to high risk until he's in a position or she's in a position to understand the relationship between risk and return, is in a position to increase us or his risk appetite. Remember also, this is a retiree who does not have the luxury of time to recover from a potential loss. So we want to minimize his losses as much as possible. So on a monthly average, we shall be expecting to receive 101,000 shillings. All right. What are the disadvantages or what are the advantages of having this portfolio or having this kind of a portfolio, conservative portfolio? Number one, we have wealth preservation. Your initial principal, the chances of losing your initial principal is minimized. Number two, this protection against market fluctuation. Why? Because you have gone into the low risk assets, money market funds, treasury bonds, fixed deposit in banks. All right. Number three, you have predictable returns. You're receiving coupons from the government. You're receiving your discount from the treasury bills. The interest that your bank is paying you on your bank deposits, on your fixed deposit banks with your fixed deposits with the bank. All right. The money that you're expecting from your special funds. Okay. There is a predictable return on investment. It also has the advantage of liquidity. It's a highly liquid portfolio. If you decide that you want to exit the country and you want to relocate to start your life elsewhere, it's very easy to liquidate your assets, take your money, your entire 8 million, and relocate. Okay, so those are the advantages of having a conservative portfolio. Does it have any downside? Yes, it does. It has a limited growth potential because we have gone for the low risk assets. Okay, and then because these assets are mostly invested in debt instruments, it is sensitive to fluctuation in interest rates. For instance, the people who had invested in MMF in 2023 and were making 14%, 16% on investment, and then now they are making 7% and 8%, they will consider MMFs not a worthy investment. Why? Because of the effect of that fluctuation in interest rates from the 16% to 14%. Or the people who had focused on treasury bills when bills were at 16% and now bills are at 7%. Interest rate sensitivity. Another disadvantage is that it predisposes you to horizon risk. Why? Because you are earning a very conservative return on investment. And so the amount that is available for you to reinvest is minimal unless you are able to reinvest, unless you are able to make reinvestment so that your money can compound and can grow faster. Then it will mean that you stand a risk of withdrawing or utilizing a portion of your principal in the foreseeable future, okay? And once you start digging into your principal, then you stand a risk of horizon risk. Another disadvantage is inflation. The low returns predisposes you to inflation. Remember, we are only earning 101 from this. And the investments where we have picked, the conservative places we have taken up this money, are where at the end of the day, if you are to take your returns now and keep your capital there for the next 5 years, then you'll have lost value in that investment. Why? Because of inflation. Unlike investment in shares, where 5 years from now or 7 years from now, you expect the value of your shares to have appreciated, even though these same companies have been paying you some dividends, okay? So those are some of the disadvantages of having a conservative portfolio. I would like us to go through some of the comments that we had in the previous video. Purity said that he should diversify 40% in bonds. I agree. 30% in special funds, 10% in money market funds, and 10% in SACCO, and 10% in cash. Well, that is a conservative portfolio, Purity. I think I like that. Perfect. Priscilla says 5 million earning 500K yearly. That's like a 10% interest. There are better avenues and needs to diversify. I agreed with you, Priscilla. This person has the potential of earning more, but has been conservative in the SACCO, probably due to lack of knowledge or due to a very low risk appetite. Jay Kaduda said a quick and dirty option list. 40% government bonds, 20% special funds, spread to 2, 50-50. I would actually do it to 3. 20% SACCO and 20% MMF. That is also another example, a good example of a conservative portfolio. From 8 million, diversify the investment, 30% to the SACCO, 50% to bonds, 10% stocks, and 10% to agriculture. This also sounds like a conservative one because we have 80% in the low risk SACCO and bonds, and we have 10% in stocks and 10% in agriculture. All right. But remember, this person says they don't have any knowledge on agriculture. They have no other business knowledge, but you can always give it a try. That's another conservative portfolio. Awesome. Kawere says he's not a risk taker, just give him full bonds. Full bonds would also be a conservative portfolio. All right. But it might not help you to achieve all the investment or all your investment objectives. Why? Because sometimes you might be in need of money. It might not be ideal for emergency funds, okay? So yes, but full bonds is also conservative. An interesting comment, that golf club comment is the devil whispering in the poster's ear. Retirement on a limited income is not the time to inflate his or her lifestyle with status symbols of that kind. Yes, I fully agree with you. Why? This is actually some of the things we had discussed in the retirement mistakes that most retirees make, adjusting your lifestyle. So this video, I hope that by now we have understood the concept behind a conservative portfolio and why, as an investor, you must always begin by setting up your objectives, by identifying your risk appetite so that you can align your investment, you can align your portfolio to your risk appetite and to your objective. And don't forget to do portfolio rebalancing. All right? Thank you so much for tuning in to this channel once more. My name is Berlin, and let's meet on the next video.